Okay, now we'll come to paragraph 4.3, issue requirements. So this is a long paragraph where we are going to learn the compliances relating to issue of share. So tomorrow you will also list your company, okay, after some years. Keep this page with you. This will help you to understand what are the formalities you'll have to complete to get your company listed on the stock exchange. So this page is a part of SEBI guideline only. You have to only write what is written here, not your own guideline. So SEBI has laid down the entry norms for entities making a public issue or offer. The same are detailed below. So those who want to get listed, okay, they have to follow these guidelines. So next is entry norms. Entry norms are different routes available to an issuer for accessing the capital market by way of public issue. That means what are the different ways you can raise money from the capital market by public issue. Now under that we have 2-3 norms we will see. These are meant for protecting the investor by restricting fundraising by companies if they do not satisfy the entry requirement. So there is a gate, but outside that gate there is a chowkidar, a watchman, SEBI, and he says show your entry ticket. If you show the right entry ticket, you are allowed to enter the gate and raise money. Otherwise he will stop you at the gate. Student is saying chowkidar is chore. My God, don't become like a politician. So what are these guidelines? Answer according to situation. Answer according to situation. So first is, who wants to raise money in the first entry norm 1? An unlisted company. The first condition is it should be an unlisted entity making a public issue, that is IPO. For the first time it is going to raise money, is required to satisfy the following provisions. Unlisted company raising funds for the first time. Say for example you, okay, so they have to comply with entry norm 1, commonly known as profitability route. Why it is known as profitability route? Normally if you are a very high profit making company for last few years, which we will see exactly, welcome to stock market. Okay, so first is entry norm 1 for profitable companies, commonly known as profitability route. Because these questions I have seen in the exam or similar questions, the issuer will have to meet the following requirement. Net tangible asset. That means you will not add intangible asset here. Even though in the balance sheet you have goodwill, brand, trademark, those will not be added. Because the reason is many companies artificially create some intangible asset in the books of account through some or the other entries. Okay, they will acquire a small company, pay a huge brand value, create brand. The small company will be somewhere related to them only, so money will come back to the promoter. We are very smart Indians. So therefore tangible asset means it will have some physical existence which can be proved that this is the building, this is the machine, this is the inventory. Net tangible asset of at least 3 crore in each of the preceding 3 full years. So in each of the 3 preceding full years, means 12 months, your net tangible asset should be 3 crore, out of which not more than 50% are held in monetary asset. And not more than 50% should be held in monetary asset. What is monetary asset? Monetary assets where the amount are determined in monetary terms, like you have learnt in accounting standard 11 also. Foreign exchange, cash and bank is a monetary asset, debtor is a monetary asset, bills receivable, loan given, government securities, bank FD, where the amount is fixed or determinable. So they are putting less reliance on monetary asset. Because again, the debtors figures are subject to manipulations. Is it right? So not more than 50% should be on monetary asset. However, the limit of 50% on monetary asset shall not be applicable in the case of public offer is made entirely through offer for sale. This limit is not applicable if the public offer is made entirely through offer for sale. Do you think you have written a note on offer for sale in your own handwriting today? Yes or no? It is bulk sale by the promoters. Okay. So sometime instead of selling directly to the public, first it is sold to another party, bulk sale, and they sell it to other investors. That is called offer for sale. So I'll just quickly tell you how the offer for sale will work. Suppose this is one entity. It will sell to another entity which is technically called sponsor, bulk shares, and then they will sell to investors. Because many times generally this route is used by companies who cannot raise funds directly from the investor. They may not have a very good reputation. In that case, this 50% monetary asset ceiling is not applicable. Okay. But if you are raising money through public offer, not through offer for sale, then your monetary asset should not be more than 50%. Then minimum rupees 15 crore as average pre-tax operating profit in at least 3 of the immediately preceding 5 years. So you should have, suppose last 5 years, in at least 3 years, any 3 year, your profit should be 15 crore or more. 3 out of 5 years should generate a profit of rupees 15 crore or more. So that is why I said I will issue shares after 3 years. Did you remember? Because right now I am not able to. Net worth of at least rupees 1 crore in each of the preceding 3 full years. This I am able to fulfill. Okay. This also I am able to fulfill, but this is preventing me. Profit of rupees 15 crore in last 3 out of 5 years. We will help you. Okay. Give me money only, na. So that is the simple way you can help me. If the company has changed its name, now some companies can change their names. So then for them the rule is slightly different. If the company has changed its name in the last 1 year, if you change the name, at least 50% of the revenue of the preceding 1 year should be from the activity suggested by the new name. 50% of the revenue should be from the activity undertaken under the new brand name or new name of the company. Okay. These are all designed to protect the interest of the public. Okay. Point number E, the aggregate of the proposed issue. Aggregate of the proposed issue and all the previous issues made in the same financial year in terms of issue size does not exceed 5 times its pre-issue net worth as per the audited balance sheet of the preceding financial year. This we had seen in the qualified institutional placement also. The same entry norm 1 is applicable here, that aggregate of the proposed issue, and if you have made any previous issues, then the total amount raised cannot be more than 5 times of the net worth of the previous financial year. So these are the tough conditions actually. To satisfy all these conditions may be tough, So what they have done, there is an alternative route to the companies not satisfying any of the above conditions. You have to satisfy all conditions, 5, A, B, C, D, E, to provide sufficient flexibility and also to ensure that genuine companies are not limited from fundraising on account of strict parameters. SEBI has provided the alternative route to the companies not satisfying any of the above conditions for accessing the primary market as under. So now suppose you are not able to go through gate number 1, entry 1, go to second gate. Okay, if you can't satisfy net tangible asset of 3 crore, profit of 15 crore, net worth of 1 crore, then monetary assets should not be more than 50%. If you have changed the name, your revenue should be 50% or more under the new name, etc. etc. Then there is an alternative route which we are going to call entry norm 2, commonly known as QIB route. What is QIB? Qualified institutional buyers. Issue shall be made through book building route. So you can use book building. Book building we will discuss after one page, where you don't give a fixed price to the investor. You invite bids from the investor at what price they want to buy, how many shares they want to buy. Okay. And after receiving bids from large number of investors, you decide a cutoff price, and those who applied above that cutoff price, they are issued the shares. Others are rejected. So issue shall be through book building route with at least 75% of net offer to public to be mandatorily allotted to the qualified institutional buyer. This is route number 2. Go for book building route, and minimum 75% you will allot to QIB. The company shall refund the subscription money if the minimum subscription of QIB is not attained. So SEBI guidelines says minimum 75% should be allotted to QIB. If 75% cannot be issued to QIB, then you have to refund. Now come to next paragraph. I can go through this route. Yeah, you're right. Thank you for your advice. Send me the bill with GST. Now, paragraph 2. A listed issuer making a public issue. Now, paragraph 2 is applicable to listed issuer. Underline, I have done it for you. Paragraph 1 was applicable to unlisted. For unlisted, how many entry routes are there? 1 and 2. Entry 1, profitability route. Entry 2, QIB route. And for listed company, now listed company can't make IPO. IPO can be only made by unlisted company. So listed company can go for follow-on public offer. A listed company making a public issue, FPO, follow-on public offer, second, third, fourth time is required to satisfy the following requirement. So under that we have, if the company has changed its name within 1 year, at least 50% of the revenue of the preceding 1 year should be from the activity suggested by the new name. Is it printed in your book? Yes, point number A. This is point number B in your book. The aggregate of the proposed issue and all previous issues made in the same financial year in terms of issue size does not exceed 5 times the pre-issue net worth as per the audited balance sheet of the preceding financial year. So this condition is applicable here also. Any listed company not fulfilling these conditions shall be eligible to make a public issue by complying with the QIB route as specified for IPOs. Remember QIB route? What is the minimum percentage to be issued to QIB? 75%. And what if you are not able to achieve that 75% from QIB? You have to refund the money back. So in case you are a listed company but you can't comply A and B condition, then you go to QIB route. Okay. Issue shall be through book building route with at least 75% to be mandatorily allotted to QIB. Why 75% to QIB? Because this QIB are sophisticated, well educated and informed investors. They know how to protect their own interest. Yes or no? Because they have a team of qualified people like you. So they will do all the research before they invest. General public may not know everything about a company or may not know whether this issue is worth investing, whether the price is correct or not. But these people, it is their specialization to invest. So they are careful before putting their money. So therefore they have said 75% should be from QIB. So if 75% of QIBs are willing to invest, it means it would be a rather good company. Okay. So there must be some reason. However, there are no entry norms for a listed company making a right issue. Underline. Because these are very minor details. For right issue, you have to raise funds from existing shareholder. They know you. They know your performance. Every year you are sending them annual report, you are paying them dividend, you are sending them quarterly, half yearly reports. So therefore no complicated, long, lengthy procedure for right issue. And that is why, as I said somewhere earlier also, right issue involves lesser cost. Can you see that? Mandatory provisions to be complied with before making a public issue. Again, keep these points in mind. These are part of SEBI guideline. Whichever part we will cover today or in subsequent days, we will not repeat again while discussing SEBI guideline. Okay, in case if you want, we can discuss again. But in case if you think no, it's not required, then we will not discuss it again because it's a part of SEBI ICDR regulations. So in this chapter, a large proportion of SEBI ICDR regulations is getting covered. Understood? So once again, SEBI says if an issuer making a public issue, then it is required to comply with the following provisions. One is, you may have learnt in Companies Act also, minimum promoters contribution and lock-in. Who is raising the money? Promoters. So promoters should also be a stakeholder in the company. Otherwise he will not be serious. Unless your own skin is in the game, you are not serious about the game. Yes or no? So therefore SEBI says promoter also have to invest some amount, and not only that, it has to be locked in for a certain number of years. It should not happen that he raises the money, himself removes his money and runs away. It should not happen. So therefore, to check the seriousness of the promoter, to ensure that only serious promoters enter the capital market, these conditions are there. In a public issue, by an unlisted issuer, who are issuing for the first time, IPO, the promoter's contribution shall not be less than 20% of the post-issue capital. 20% of post-issue capital. After the share capital has been issued, 20% should be promoter's capital out of. Okay. Second is, it should be logged in for 3 years. What is logged in for 3 years? Freeze on the share. He cannot transfer it to others. So that for 3 years he will be serious. Because if the company loses, suppose company loses its money, his money will also be lost in that process. So he will be more serious about the company, will take proper decision. The remaining pre-issue capital of the promoter, pre-issue capital, whatever amount he had already invested before the IPO, shall also be logged in for a period of 1 year from the date of listing. Whatever share he has purchased in IPO will be logged in for 3 years, and pre-issue capital will be logged in for 1 year. His capital should be 20% of the post-issue capital. Okay. In case of a public issue by a listed issuer, that is FPO, follow on public offer, the promoter shall contribute not less than, so he's been given a choice here, promoter is given a choice that you can keep your capital not less than either 20% of post issue or 20% of issue size, either or. Promoter's capital in the case of listed company which is going for FPO will be 20% of post issue, that is calculate the post issue capital 20%, or 20% of issue size. Suppose you are raising 1000 crore to 100%, 20%, 200 crore, okay, will be your. Who has to take a call what he wants? The promoter will take a decision whether he wants 20% of post issue or 20% of issue size. Whichever is lower he will choose, okay, but this is left to the promoter, he will decide. In case where the promoter contribution has been brought in and utilized, then a cash flow statement disclosing the use of funds in the offer document shall be included. So promoter's contribution, if it has been brought in, then offer document will also include the utilization of funds, cash flow statement, inflow, outflow. The provision ensure that. Why such complicated and difficult provisions for promoters? Point number F says these provisions ensure that promoters of the company have some minimum stake in the company for a minimum period after the issue or after the project for which funds have been raised from the public is coming. He has invested his own money and plus it has a lock-in period for 3 years. So therefore his own interest is there in the company. Otherwise he will raise the money and he can lutify the public, run away with all those money, okay. In any case people do that in spite of so many regulations. Without regulation it will be more easier. Yes sir. So SEBI ensure that it is minimum or it does not happen. The scam, fraud does not happen. So complicated procedures are there. IPO grading. Now to protect the interest of the investor, there was a provision of credit rating of public issue by recognized credit rating companies. I use the word was because now it has become optional. It was mandatory for some time. What is the purpose of credit rating of an public issue? Because the investor will understand what is the nature of the issue, what is the risk involved, is it a good company. Ordinary investor may not have so much time, energy and knowledge to do the research on his own. So at least by credit rating company, when the rating comes to him, he will get some idea about the quality of that issue. With that objective, credit rating was introduced for IPOs. Disclosure of IPO grades to obtain is mandatory for companies coming out with an IPO, but later on it was made optional. The grade represent a relative assessment of the fundamentals of that issue in relation to other listed securities in India. It was actually a very good move, okay, because many companies started coming out one by one at whatever premium they wanted, and then after some years we find that those shares are now worth a few rupees only, 80-90% decline. So now at least something is better, okay. So it will give information about the fundamentals of the company. If there are already existing companies in the same line of business, they can do the comparison. Such grading is generally assigned on a 5-point scale. So there is a scale of 1 to 5 and each has a meaning. Lower point means a worse company, not a very good company, and as you move from 1 to 5, it is treated as a stronger and better company. Okay, just like a rating of a movie, 1 star, bekar movie, okay, not worth watching, 5 star, you should go. Yes or no? So the rating is like a movie rating, 5-star rating. If you get only grade 1, poor fundamental, avoid. Below average fundamental, grade 2. Grade 3, average. Grade 4, above average. Oh, superstar. Grade 5, strong fundamental. So even though you don't know much about the company, but at least this will give you an idea that what is the fundamental of the company, and according to your risk taking abilities you will invest. So will you be able to remember these grades? Yes, or you can read the answer. IPO grading has been introduced. What was the objective? As an endeavor to make additional information available for the investor in order to facilitate their assessment of fundamentals of the company, offering equity share through an IPO. SEBI is trying to give more information to the investor so that they can take the informed decision. Practically speaking, many small and retail investors, they don't know anything about the company. They just go by the newspaper gossips, TV gossips, friends gossip, some SMS he receives on the mobile, some email he receives, and he takes decision on the basis of that. And in the process, they are cheated also. Is it right? And many investors have been cheated in last so many years because of this heavy marketing of public issue. So to protect them, this IPO grading was introduced. IPO grading can be done either before filing the draft offer document with SEBI or thereafter. Do you remember draft offer document? This is the first stage in inviting the money from the people. First to submit draft offer document, then prospectus or red herring prospectus, okay, then prospectus. However, the prospectus or red herring prospectus, as the case may be, why as the case may be, if it is a fixed price issue, prospectus is submitted to ROC. If it is a book building route, RHP is submitted to ROC, must contain the grades given to IPO by all the CRA, credit rating agencies, approached by the company for grading such IPO. If you have appointed more than one credit rating agency, whatever rating each company has given, you have to disclose each of them. The company desirous of making the IPO is required to bear the expenses incurred for grading an IPO. Who will pay the fees to credit rating company? Company. Will the investor bear the expenses? No. Then one student had asked me, you are paying fees to credit rating and they are only going to evaluate you. So don't you think their independence is compromised? Yes or no? But same is applicable to auditor also. Same is applicable to, don't you think you get fees from your client and you prepare their statutory reports? You write that CARO report. I don't know what is that called now. CARO auditor's report. In our opinion, the company's books of accounts show true and fair view, and they only have paid you the fees. But that is the difficult part of the credit rating process. Many times their integrity might be compromised, okay, but don't write that in the exam. Further, IPO grading is optional now. Previously it was mandated, underline. With effect from the date is also given, February 4, 2014, IPO grading has been made optional for the issuer. Optional means some companies, suppose they want to create confidence among the investors, so they can voluntarily go for IPO grading, and if he gets 5 rating, it will use it for marketing tool. If he gets 1 rating, it will not disclose it. Okay, good or bad? IPO grading process is expected to take into account what these credit rating companies do. They will come meet the management team study the balance sheet, P&L account, business prospect, the prospect of the industry in which the company operates, the competitive strength of the company that would allow it to address the risk inherent in the business and capitalize on the opportunities available, as well as company's financial position. What are the risks? How the company is going to overcome it? What are the financial strength of the company? Based on that, the grading is done. While the actual factor considered for grading may not be identical or limited to the following areas listed below, take mark this question, because there is a chapter in our syllabus, credit rating, a separate chapter, and this question can be asked, what are the aspects which are looked into by the credit rating companies before they give a rating or a grading? Okay, so you should know this. And as I told you, this credit rating is again a growing business in India, and they are hiring a lot of chartered accountants also. This can be a question in your interview also, that suppose we hire you and we ask you to do the grading or rating of a company, what 5 or 10 parameters you are going to check? This page for you. You will say, we'll see the business prospects, whether this company's business model has a future or not. Is it right? So business models need to keep changing or evolve. Existing business may not survive for a long term. Is it right? Like for example, companies making, let's say, mobile phones based on certain technologies. Probably a new technology will come and your business will go out of the market. You are manufacturing a car based on, say, diesel. It's a good quality car, but government can ban the diesel cars only altogether, right? Or maybe public transport system will improve to such an extent people will not buy cars. Like in Japan, if you go to Tokyo, you will not find too many cars compared to the size of the country and the wealth of that country. Why? Because most people use, even billionaires use the public transport system. That is so good. Yes or no? Because everywhere at a distance of 50, 100 meters, 200 meters, there is a station, metro, and you just go there, you take a pass, you enjoy rides. Trains are on time, trains are clean, and every 5 to 7 minutes from any place to any place the trains are available. Can you believe that? I have been to Tokyo in that metro for many times. Many times, almost 50 times I used it. And I found that it is very convenient, cost worthy, efficient. Why do I need to buy a car? Plus what they have done in Tokyo, parking is very expensive. Even if you stay in a flat, you have to pay for the parking. Yearly parking cost is more than the cost of a car. Yes, you heard me right. I have seen it, because I have been with a friend who used to park his car. For 1 hour they will charge 600 rupees parking fees. 1 hour 600 rupees. In India we park anywhere free of cost for 3-4 days also. There if you park for 3 days, you have to pay something like some 50-60,000 rupees parking fees. Otherwise you can't move the car. They block the car using technology. The car does not move only. Only when you put the money in that slot which is next to that parking lot, then the car can move. Otherwise it doesn't move only. Don't park only. Police will come and take away your car, and then there is a penalty for that also. You can't mischief in Tokyo, I'll tell you. Don't even try. Okay, so that was just an idea about business prospect. How car industry can become outdated. That was my case. Either the government can ban some car, or the public system can improve to such an extent that it will not work. And competition position may change. industry prospect you have to see, company prospect, financial position, management quality, then corporate governance practices. Are the management honest in their disclosures? Are the management ethical in their dealings? Is it right? Are there conflict of interests? These are the things they check. Then, is the company regularly complying with the laws? What is the litigation history? If there is a new project, what is the risk and prospects? These are few examples which credit rating company looks into. And it may be noted that the above is only indicative of some of the factors considered in the IPO grading process. But at least this 5 or 6 points you can mark. IPO grading is done without taking into account the price at which security is offered in the IPO. So they're clarifying some points. IPO grading is not related to price at which shares are issued. It's not that if you issue share at a higher price, they will give you higher grading. These are independent calculations. Grading and pricing are independent calculations. Since IPO grading does not consider the issue price, the investor needs to make an independent judgment regarding the price at which bid for or subscribe to the shares offered through the IPO. Credit rating does not tell you whether the price at which shares are being offered is right or wrong. That is your independent judgment. We are telling you only about the fundamentals of the company. IPO grading is intended to provide the investor with an informed and objective opinion. What is the purpose? Informed. That means be aware. And objective means unbiased. Now, how much is it objective is depend on the credit rating company and the employees of that company. Because in some books I have read, many times this opinion is subjective, compromised, because management and the credit rating company may have some conflict of interest. It may not be fully independent, and therefore they might not be honest. Be careful. By a professional rating agency, after analyzing factors like already discussed business and financial prospect, management quality, corporate governance practice. Now this point I have explained. Even though grade is given by the agency, the investor needs to make his or her own independent decision regarding investing in the issue after studying the contents of the prospectus, including risk factors, carefully. You must have heard this sentence in many advertisements. Please read the offer documents. Investment is subject to market risk. Please read the offer document carefully. Prospectus is also an offer document. Because you can't later on go to court and file a case against the credit rating company. Is it right? Because that is your decision to invest or not. SEBI does not play any role in the assessment made by the grading agency. So SEBI has no influence in the grading. Grading is done by an independent company and it is an unbiased opinion. SEBI does not pass any judgment on the quality of the issuer company. SEBI will only ensure that all the regulations have been complied with. Whether that business model is good or not is not my job to decide. Is it right? I have to only ensure he has complied with all the disclosures and legal requirements. SEBI's observation on the IPO document are entirely independent of the IPO grading process or the grade received by the company. Is the grading clear? Simple. But good news is that it is optional now, so many companies may not go for it. Next is pricing of an issue. Again, these are SEBI guidelines. Although in our SFM batch we have learned what we have learned, valuation of share, valuation of bonds, but that is also subject to SEBI guidelines. Okay, pricing of an issue. One of the most difficult tasks is what is the right price of a share. From my limited knowledge, I have concluded you can't really say what is the right price of a share. Some degree of subjectivity is going to be there because it's always based on future earnings of the company. Yes or no? Some companies like Apple, even their share prices have gone down by 15 to 18%. Companies like Facebook, their share prices have also gone by percentages, lot of percent. Reliance Power, how many percentage down from the IPO price? About 80-90%. So what is the right price? Is always a question mark. However, lot of changes have taken place since 1992, that is the year when SEBI regulations came. Indian primary market ushered in an era of free pricing. Free pricing means companies are free to decide at what price they want to issue the share. That is called free price. Does SEBI tell them that only you can issue at 110 rupees? No. SEBI does not have a role in price fixation. So what companies do, company hire merchant bankers. These are the experts. They have a team of valuers. Okay. People like you will join merchant banking companies in future. Possibly. You may join JP Morgan, Goldman Sachs. Okay. Some more companies. And then you will get the chance to do the valuation of IPO. So you and the company will sit down and they will decide at what price the share should be offered, which will depend on market demand, etc. The offer document contains full disclosure of the parameters. Whatever price you want to charge, disclose the parameters which were taken into account by the merchant banker and the issuer for deciding the price. So you can choose the price, but then you have to disclose the parameters. You will ask, what are these parameters? Some parameters are mentioned in the note. One of the most important parameters is EPS, earnings. Ultimately, why are we paying for a share? Because we will be the stakeholder in the future earning of that company. Yes or no? Then earnings P multiple, price earning multiple. There is a formula for calculating market price, which I have learned in intermediate. Market price of share is EPS into price earning ratio. So if you have used P multiple, disclose that which P multiple you have used, so that the other investor can evaluate whether so much of P multiple is justified for this business, this company. Okay, if other companies are having lower P multiple, why you are charging higher P multiple? Then you have to disclose what is the return on net worth you have used. Comparison of these parameters with peer group companies, companies in same line of business. These are the disclosures. Based on that, the investor will take a more informed decision. Okay, and if investor don't like it, they may not subscribe. They may request the company to reduce the issue price. Yes, it happens sometimes, very rarely, but it has happened in India that company had to withdraw their IPO because they found there are no takers. Okay, so classification of issue on the basis of pricing. Since beginning today, we are discussing there are two ways pricing can be done. One is called fixed price issue and one is called book building issue. Okay, fixed price issue is what you learn in your 11 standard accounts batch. X Limited wants to issue equity share Issue price is 15 rupees, 5 rupees on application, 5 rupees on allotment, 5 rupees on call. But 15 rupees which you have learnt in 11, 12 accounts batch, even in your inter may be some question, is a fixed price method. Okay. Company says this is the price, take it or leave it. Investors have no say in determination of the price. When the issuer at the outset decides the issue price and mentions it in the offer document, it is called fixed price issue. Okay. But sometimes, in fact nowadays, CBS said go for book building route, where the investor has a say in the pricing of the issue. Companies, what they do now, they give you a price range. What is the price range they give? 200 to 220. The maximum gap right now as per the regulation cannot be more than 20%. This is called floor price. This is cap. So cap cannot be more than 20%, but at least the 20% range is there. So you can bid at 200, 210, 215, 220. So at least some role the investor has in price determination. So many people say book building brings democracy in the capital market, because investor also gets a chance to participate in the decision making process about pricing of the issue. So point number next is, when the price of an issue is discovered on the basis of demand received from the prospective investor at various price level, it is called book build issue. So they open a book, not an accounting book, a general, it is called book, where they will make a list of at what price how many shares were say bidded by the investor, and then they will decide a cutoff price so that the company gets the desired amount of funds at that cutoff price. Okay, one example we'll discuss later. Issuer may disclose them in the draft prospectus in the case of fixed price issue, and the floor price or price band in the red herring prospectus in the case of book build issue. Lot of repetitions. If it is a fixed price issue, you can disclose them in the draft prospectus also as well as the prospectus. But if it is a book building process, then you have to disclose either floor price, means the lower price, or you can disclose even the price band, because as you know in India it can't be more than 20%. So even if you disclose the floor price, the ROC knows that it cannot be more than 20%, the cap. The issuer is required to announce the floor price or price band at least 5 working days before the opening of the issue. Now these are some details which you have to remember, or at least know that this exists in the syllabus. If you are going for book building route, the floor price or price band will be announced 5 days before in case of IPO, and 1 working days before the opening of the issue in case of FPO. Okay, so a good student, what he does, 5 days IPO, 1 day FPO. In all the newspapers in which the pre-issue advertisement was released, let the investor be given some time to make up his mind also. Is it right? Because IPO is by an unlisted company, give him more time to think, more time to evaluate. FPO is by a listed company, so already there is a market price in the stock market at which the shares are trading. So only 1 day is enough. Okay. So this is about book building. Have you done? And now next is intermediaries in the capital market. This I am going to go through little fast, because I think this we have covered in earlier chapters also, chapter 1 and 2. And in this chapter also at several places in bits and pieces. So little fast. Okay, ready? Who are the intermediaries? These are the service providers. They are required. This diagram is there in your book. They are the service providers. They will make the working of capital market smooth, efficient, fast. Execute. They do the execution. They help the investor. They help the companies. Okay. So who are these people on the screen? Not in a particular sequence. Investment bank, portfolio manager, investment advisor, investment funds, brokerage firms, custodian, depository, participant, debenture, trustees, underwriters, bankers. Okay. So now I will take one by one. First, we'll take merchant bankers or lead managers. These are the most important people in public issue. Okay. Because compulsorily you have to hire a merchant banker who is also called a lead manager. He takes the lead. He is the boss as far as execution of IPO is concerned. Because businessmen may not know the legal procedure. Yes or no? Suppose you are a Anil Ambani, you are Mr. Anil Ambani, you are not technically, legally qualified for all these activities, but you want to raise money from the capital market. You have to hire a merchant banker. These are big banks, big investment banks with a lot of experience, a lot of qualified people like you who work there. Is a person who is engaged in the business of issue management. Their main task is issue management, public issue, by making arrangement regarding purchase and sale of security and also rendering corporate advisory services in relation to issue management. One service we saw just now, some time back, pricing of share, is done in consultation with merchant banker. A businessman will not know what is the price I should charge for my security. Is it right? So then they take the help of these merchant bankers. Then he also conducts due diligence of pre-issue and post-issue activities of public issue. Hence, you have to ensure that all pre and post-issue compliances are properly done. Then there are underwriters. Underwriters, as you know, are the people who give insurance to the company that certain subscription will be achieved. If public don't subscribe, we will subscribe. Who are these underwriters? These are usually the investment banks that have IPO specialists on their staff. This investment bank work with the company to ensure that all regulatory requirements are satisfied. The underwriter contacts a large number of investment organizations. Why do we go to underwriters? So these are specialized entities. They have a huge network of investors. They know who are the retail investor, institutional investor, high net worth individual, and immediately they will contact all these possible investors, submit them whatever information, prospectus, advertisement they want, convince them, persuade them to subscribe. Is it right? So who are these big investors in India? Mutual fund, insurance companies. And these underwriters, after talking to this investor, get an idea that what is the interest of the investors in this company. The impact of interest received by this large institutional investor help the underwriter to set the IPO price of the company stock also. So they may help in pricing after knowing the opinion of investors. They have a network. We will tell them we are going to come out with this issue. What do you think should be the price, etc. The underwriter also guarantees. This is what we learnt in accounts batch. But he does a lot of other activities which is printed here. Specific number of shares will be sold, and if there is any unsold share, he will purchase it. Do we need bankers? Yes. Role of banker is also very significant here. large number of people from different part of the country will make application. Okay, then it has to be transferred to company's bank account. For those applicants who are not allotted, their money has to be refunded. Okay, so therefore the company will have to appoint a scheduled bank which will carry out the following activities: acceptance of application and application money. So nowadays there is a concept of ASBA, ASBA, which I am going to discuss after a few paragraphs. So you have to go to a bank, ask the bank that I want to subscribe to the shares of this company, but I don't want to issue check draft to that company. What this bank will do, they will block the amount. They will block your bank account for that much amount, so that you don't have to send money to the company, but money will remain blocked till the decision of the company to allot or not to allot. If it is allotted, money will be transferred from your bank account to company's bank account. If it is not allotted, the account will be defrozen. Defrozen means now you can use it. Advantage is that you continue to earn interest on that amount. You continue to earn the interest on that amount, and obviously lot of time and energy saved in that process. Companies also benefited, otherwise they have to issue refund checks, refund orders, etc. So lot of hassles have been eliminated through this ASBA. So you have to file an application. There are so many banks which are now authorized to accept ASBA and application money. And then acceptance of allotment or call money, in case if the money will be paid in 2-3 installments. Refund of application money, banks are required to pay dividend or interest to the investors. So the role of bank is also very significant. Then there is a broker. Underwriter and brokers are different. Broker's main objective will be just to bring the subscription to the company. Okay, they don't guarantee anything, but they have a large network of investors, clients. So normally what these companies do, they also take the help of broker because they know the people in the local areas, for example. So brokers get a lot of application money. Then the brokers call their 100, 200,000 clients. Let's see, we have got this application, come to our office or tell us, we will help you. You can make the application. And they get some commission. So brokers are either individual or firms that charges a fees or commission for executing buying and selling orders submitted by the investor. The role of a broker is that it acts as an agent for a customer. Again, as you know, many people may not know the technicalities of stock market. Yes or no? A lot of people don't know how to purchase a share in the stock market. Simple advice to such people: find a good broker near you. Okay, and then you tell him what you want, and then he will help you out. But he will charge you some fees or commission. In case of debenture issue, where the funds are raised from large number of people, somebody must be there to protect their interest. Individual debenture holder can't fight with the company, can he? I have purchased 15 debenture of 100 rupees, is 1500 rupees. Example. For 1500 rupees, I am not going to file a case against the company. My legal fees will be more than that. But then all these debenture holders together, as a party who protect their interest, is debenture trustee, and it is mandatory to have a debenture trustee. He can be a person or an entity that serves as the holder of the debenture stock for the benefit of another party. When a company is looking to raise capital, one method of this is by issuing stock as a form of debt with the obligation to repay the debt at a specific interest rate. and then they appoint a debenture trustee to protect the interest of debenture holders. Registrar to an issue means the person appointed by a body, corporate, or any person of group or group of person to carry out the following activities. So these are basically like administrators of the entire issue process. Okay, they collect application from investor in respect of an issue. They keep a record of the application. They are record keepers, you can say. They are record keepers. And money received from investors or paid to the seller of the security. They assist body, corporate, or person or group of person in determining the basis of allotment of securities. So even they help the company in allotment. Who should be allotted? Sometimes there is an oversubscription. So then the registrar, the issuer, the merchant banker, the stock exchange, they sit down and decide to whom it should be allotted, and then finalizing the list of person entitled to allotment of securities. Processing and dispatching allotment letters, refund orders or certificates and other documents in respect of the issue. Would you like to work in a registrar? It's more a clerical task, administrative task, maintaining record, dispatching allotment letter, dispatching refund. Okay, but somebody has to take care of all these activities so that investors are served properly on time. So registrar is to be appointed. Next is people like you, the portfolio managers. That is, those people give advice to their clients. Where should they invest? How much they should invest? When should, how much, in what proportion, when should they sell? They help in a lot of planning. Okay. In fact, I suggest that those who have wealth and if they can't manage it on their own, they can go for portfolio manager service. Okay. You can come to me also, yes. But there is a fees you have to pay. I'll give you discount, 5% discount. Fees is 50% of the profit. Now, a portfolio manager is a person or group of person responsible for investing in a mutual fund, exchange traded fund or closed-ended funds asset, implementing investment strategy, managing day-to-day portfolio trading. So that is portfolio manager. It's a booming service now. Some of you can think of becoming a portfolio manager as a full-time career also. Okay. Of course, you have to provide good service to your client, honest service, ethical service. Keep the interest of the client before anything. Then people will trust you. Okay, and then you can get good amount of money. But it is a very hard working job. You have to continuously update yourself, know about the financial products in and out. Is it right? Somebody wants, I want to invest in this mutual fund. What is your recommendation? You should know what is that fund. He says, I want to purchase this share. You should know what is the benefit. He says, I want to save taxes. You should know what are the available options for this person. And then you should carry out whatever strategies you have designed for him, because he may not have the time and also the knowledge to execute. Okay. Portfolio managers can be active or passive. Okay. Sometimes they take instruction from the client, sometimes they execute on their own. And historical performance records indicate that only a minority of active fund managers consistently beat the market. Beat the market means they give more return than what market has given during a period. Okay. Diagram we have already seen. Now next part is steps involved in public issue. Long list of steps involved. Almost 16 steps only are there. Now the question in the exam are asked like this. Arrange the following steps. Arrange the following steps in a public issue, they will give you in a random manner. They'll give you in a random manner, and then how one by one the steps are executed, you have to arrange in that order. So that can be another question for say 4 marks. You can't issue share certificate before you have a board meeting and first you pass a board resolution to decide about the public issue. So first step we will say board meeting and passing a board resolution for public issue. This is the starting process. First board has to pass a resolution. Okay. Company will call a board meeting, a resolution will be passed. After that, you call the general meeting, holding of general meeting. If it is required by the article of association, that consent of the shareholder has to be obtained, then for this purpose meeting of the shareholder will be called. Sequence you have to remember. When I appeared for CP exam, question was like this only. They will give you 10 steps randomly and you have to arrange them. So of course if you have read it properly, you will be able to arrange it. If you keep searching in the book, it will take a lot of time for a 2-3 mark question. Then after the board and the shareholders have agreed, then you will appoint merchant bankers and other intermediaries and enter into an MOU. What is MOU? Memorandum of Understanding. It's a form of an agreement, but loose agreement, not as strict as a proper agreement that is executed. Okay, but it's an agreement because money is involved. Each party should know what are their rights and what are their obligations. Okay, so merchant banker and other intermediaries, those whose name we read just now. Okay, like for example, registrar, then underwriter, banker, broker. In case of debenture issue, debenture trustee, these people you have to appoint and enter into an MOU. To initiate the process, the company has to pass a board resolution and proceed to appoint a merchant banker with whom an MOU may be entered into. It is also necessary to appoint various intermediaries. Again, repetition, which are the intermediaries? Underwriter, broker, banker, registrar, custodian, depositories. Okay. For marketing the same and to enter into an agreement with the same. This is my step number 3. How many steps we have covered? First one, board meeting. Second one, shareholders meeting. Third one, appointment of merchant banker and other intermediaries. Now we will continue tomorrow.